It's the unofficial start of summer, Mike, and it is amazing how quickly things seem to be reopening.
Yeah, the economic activity is picking up rapidly. It seems like in many places the economy is reopening almost as quickly as it shut down.
Let's talk about jobs. The April jobs report was a huge miss, and we've got some insight as to why we think it was a huge miss. Let's talk about what we see in the numbers and what we can expect these numbers to trend towards.
Yeah, and the rationale that was given for why economists missed this number by such a big margin were things like, well, folks that are unemployed have been financially incentivized to not work because of the additional $300 in unemployment benefits and the stimulus checks and so on and so forth. And so that's the issue. There are a record number of job openings. So why aren't they getting filled? And if you look into the data a little more closely, so what we're looking at on this chart, the blue line is the total number of unemployed people. So right now we're at 9.8 million. The green line is the total job openings. So yes, if you look at that green line, we are at a record number of job openings, 8.1 million. But 8.1 million job openings compared to 9.8 million unemployed persons is not a great environment to be hiring in. It's actually very difficult. We contrast that to 2008. So we go to the prior recession. Coming out of 2008, there were 6.7 unemployed persons per job opening. You throw up a help wanted sign, and it's very easy to fill that position post 08. Right now, by this metric, so this ratio, the job seekers ratio, the labor market is almost as difficult of a hiring environment as it was pre-COVID.
Each state, their mileage is going to vary in this situation. So dig into the state by state picture and how it might be different.
Yeah, state by state, what we've seen is a lot of folks have moved to less densely populated, more rural areas. And the folks that have had the wherewithal to move generally have been employed and have brought with them demand for goods and services. The places they're moving generally have fewer COVID restrictions as well, so they can spend more of their money. So they take their demand with them, but that does not necessarily mean that supply of labor has gone with that demand. So the jobs are needed generally in states that have had fewer COVID restrictions and that have reopened more aggressively, and that have seen an influx of new folks coming into the state. That's where the jobs are needed, but the supply of labor has not met that. So the areas where a lot of the jobs were lost are not the areas where the jobs are needed. And it's a really tight environment to start with. When you factor in those geographic mismatches, it could be tough to get a full jobs recovery quickly.
So given that, what impact will the 23 states who are ending the $300 a week and extra unemployment benefits, what impact will that have on those particular states in their unemployment numbers?
Yeah, it's tough to speculate. That's probably part of the story. It's just not a complete explanation.
Right.
So the first states that are going to end the $300 top up, that goes into effect on June 12th. But we won't be able to see state by state data that reflects that until late Q3. So we'll see anecdotal evidence and we'll see if that helps. But in most instances, those states that are ending the $300 top up, that are dealing with these big labor shortage problems, it's a lot of it is because there just isn't the labor there. That's not where the labor is. That's where the demand is.
Right.
But that's not where the labor is.
And I would surmise, I think we would surmise that those types of jobs aren't labor relocation jobs.
Right.
So you're not going to get, mass recruiting from state to state to fill these. These are mostly lower paid service related jobs.
Right.
So I guess we've hit on a couple themes that might support a better than expected reopening and potential outcome for the economy. One of the big ones that we don't talk about a lot is the personal savings as a percentage of GDP, which again is just crazy off the chart number. So give us some context here.
So typically, so personal savings rates are typically quoted as a percentage of disposable income, or personal income. Personal income is at all-time highs. We looked at that during prior videos, right? It's about $24 trillion. So a better way to look at this now, because incomes and savings are so high compared to the size of the economy, is just looking at personal savings as a percentage of GDP. Typically our personal savings rate runs around 5%. Right now, or during Q1, personal savings as a percentage of GDP averaged 20%. So we're just talking about huge numbers.
And what does that translate to in dollars?
Yeah, so in dollar terms, your 1/5, it's right around $4 trillion just in savings. So yeah, about 1/5
It's
of
a lot
GDP.
of vacations.
Right. And savings, probably not going to see elevated saving rates for a very long time. You can see how much personal savings rates fell after the CARES Act. So that's the spike just to the left of the most recent data point. You can see how aggressively folks spent down their savings from stimulus checks and expanded unemployment. If consumers spend that down just as aggressively, especially now that there's a place to spend it as the economy reopens, once again, you're talking about a huge amount of money that's going to be pumped into the economy. We talk about how do you get double-digit GDP growth in 2021. Here it is, right? It's every consumer has it in their wallet. They just need to spend it.
I mean, in truth be told, we are clearly not a nation that saves. So, I mean, as evidenced by this line and a lot of other graphs, this money will most likely get spent and get spent rapidly.
Yeah.
Under the assumption that it will get spent, how rapidly will it get spent, and what could that potentially do to the reopening? And perhaps even, are we undershooting what the reopening is going to look like?
Yeah, there's definitely potential for that because you're dealing with such large numbers, so much in terms of excess savings. And we've already seen this swift rebound in economic activity. So these blue lines are open-tabled seated diners and TSA checkpoint traveler throughput. So your real high frequency data points tracking the COVID reopening. And they're almost back to pre-COVID levels. But what's important to note is, lockdowns, they've only eased maybe halfway. There are a tremendous number of states that still have big lockdowns in place. Things like business travel are nowhere near back to normal. So you can look at the total level of how stringent lockdowns have been in the US with the red line, the lockdown stringency index. At the highest, we were around 80. And this is just a measure of how strict lockdowns have been and state to state aggregated at the country level. We're only down to 50. And so the reopening, to get back down to near zero on a lockdown stringency, that's a lot of reopening. That's a lot of restrictions that still need to be eased. So there are going to be a lot more avenues for consumers to spend all those excess savings as we head here into the summer and fall.
And what are we thinking in terms of the timeline around full unrestricted access here? No lockdowns whatsoever. I mean, we've seen it in some states.
Yeah, even the states that have historically had the most stringent lockdowns have announced or have established plans to get towards a full reopening, somewhere midsummer.
And in terms of economic GDP growth recovery, what is the market expecting versus what could we see as an outside from this?
Yeah, well, Q2 GDP growth is expected to be about 10% now. So keep in mind, at the end of last year and then in January, the expectation was about 3% growth. Now the consensus has already moved up for the full year. Now the consensus has already moved up towards 7.5. So you can see how wrong the economists had it, right? Yeah. So the margin of error here, the estimation error, is huge because the numbers are far bigger than anything we've ever seen. We've never seen this amount of money created. We've never seen a sudden reopening of an economy. We just went through a recession in 2008 that was lackluster and consistently undershot expectations. So that was in economists' mind. It seems like the risk in terms of estimation error here is to the upside. And the economic recovery could be even stronger than folks are expecting.
And we're still in the early innings of rebuilding our inventories. There's a lot of momentum that's going to be going on here.